Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today's episode 180, Understanding Market Risk. Cory, thank you for joining me back on the show.
Thanks for having me.
You know, I found that these interviews are far more effective and impactful and frankly easier than doing the solo cast where I stare at the camera and talk for 15 minutes. So thank you.
You're welcome. I found the same thing when I'm doing my show, but it's a good thing.
Yeah, it is. Yeah, so we're evolving, we're upgrading, and we're making our content better. And so hopefully all of you out there that are tuning in or listening to this, please, if you have any feedback for Cory or I, let us know. Like I said, we're always looking to improve, and ultimately this content is for our clients. And so we want to make sure that you're getting the best use or benefit out of it.
Yep.
For today's show, I wanted to talk about market risk. And the reason I wanted to bring it up is really two reasons, Cory, is that one, the market has had an amazing run. Even though we had a 30% crash or correction or pullback, whatever you want to call that, back in 2020, it's been resilient. And the last 3 years, the market has, and by the market, I mean the S&P 500, has achieved above average returns. In fact, many times double or almost triple the historical average that we normally see, which is not normal. And it's certainly not normal probably during a pandemic, but it has done it. And so I think a lot of people are getting overconfident. And so I wanted to talk about, well, I guess that's one, is that it's gone over the average in there. And two, here recently, the NASDAQ, which is the index that tracks technology stocks, has entered correction mode already, right out of the gate. Here, it's down 10% in January as we're recording this. And so, or around 10%. So risk is here and it's definitely present. So I wanted to set up today's show into three phases. I want to talk about first the different types of risk. I want to talk about greed and how it can hurt you. And then I want to talk about what we do at Falcon Wealth Advisors to manage risk for our clients, which probably is the most important part. So let's kick right into it. And the first one is an obvious, but I think it's important that people understand. It's systemic risk is basically you're going to have risk anytime you invest your money. Pretty much in anything, right? And Cory, maybe you can expand on that a little bit.
Yes, that's exactly right. There's systemic risk and then there's non-systemic risk, right? And I think that's a good way to just start from a definition standpoint. Non-systemic risk is risk that can be mitigated via diversification, but systemic risk is risk that cannot be diversified. And we talk about this with clients in terms of how many securities someone needs to own to be diversified. But the point there is whether someone owns, 30 stocks or 300 stocks, systemic risk is always relevant. And that is the risk that comes with investing, because volatility and market pullbacks and declines, that is the price of admission when it comes to the stock market, frankly, because stocks have historically provided above average returns. But someone has had to have the stomach for, the volatility along the way. But that's what systemic risk is. It's the risk that can't be diversified short of not investing your money.
Right. And I would argue if you don't invest your money, that has its own set of risk, but which is we'll get into here in a moment. So, So if you're going to put money, if you're going to take your cash and your money and you're going to exchange it for ownership in a stock or even a bond, you're going to have some risk, right? That's just the way it works. And like you said, you've got to be able to stomach volatility in order to hopefully receive some sort of return on your capital.
But I think it's critical for people to know that risk always exists.
Right.
Your point, Jake.
Right. It's always going to be there, and that's okay. And frankly, it's good, because if that risk wasn't there, your money probably wouldn't grow. And that's what's important to understand. And so that's the core. Like that's risk 101. But there's all these different non-systemic or different types and shapes of form of risk.
Satellite risks, might you say?
Satellite risk. I like that, Cory. Did you come up with that, or is that?
I did. If systemic is the core, there's these satellites of other types of risk around it.
So there's all these satellite risks. So political risk is a big one. A political risk we're seeing in China right now with what their government is doing on certain companies. Political risk is here in the United States on who controls the White House and who controls the Senate and controls the House. They dictate law, right, and which changes the rules. Interest rate risk is big, right? If interest rates go up, what does that do to certain types of investments? Inflation is a type of risk. What are some other ones, Cory?
Those are big ones. Systemic, political, interest rates, inflation. I don't know if you would define headline risk as being maybe part of political or part of any of those other ones, but that would be relevant too.
No, absolutely. Yeah, headline risk is a big one, right? Especially with some of these large technology companies that some of them are facing, pressure.
Yeah, the antitrust environment we're in right now.
Yes, exactly. So headline risk is a good one, actually. And then there's sector risk and diversification risk is a big one, right? I mean, if you're too concentrated in either any one investment or if you're too concentrated in any one sector, if you've got all your money loaded up in technology, that may be really good in some years, but that may be really bad in other years. So you've got to understand the risk that you're taking, right? So there's all these different types of risk. It's just important to know that there is no sure bet. There is no guarantee. I don't care what people tell you, there's not. And so you want to make sure, or at least we do this for our clients, and I'm going to talk about this towards the end of the show, that you're managing all those different types of risk so that ultimately your nest egg isn't overexposed and doesn't get caught, what does Warren Buffett say? You find out who's naked when the tide comes back out, right? So everybody looks fine and dandy when the market's up, but when the market pulls back, are you overexposed and have you been investing inappropriately? Are you paying too much in fees? Do you have too much in one stock? Do you have too much in one country? Like all of those things could be overexposing you unnecessarily, frankly. So it's something that's very important, something that I don't think is talked about enough. And again, I get it. We've been through a pandemic, which is horrible, but the market's been resilient. And so people forget that, yeah, you've got money in stocks and maybe you have money in crypto or meme stocks or penny stocks. All that stuff has got risk and you can lose all of your money. So you want to be very careful on what you're doing out there. It's not something to be taken lightly.
I don't know, Jake, if you've seen any of the charts that are floating around, but exactly to your point, thinking about crypto, thinking about meme stocks, thinking about specific sectors, some of the speculative mania that was relevant in 2021, especially in the first couple of months of the year. This time last year is when everything was going crazy with Reddit and Wall Street bets and meme stocks, et cetera. A ton of those companies have done basically a full round trip where a stock has gone from $20 a share to $170 a share, all the way back to $20 a share. And that's all happened within 12 to 18 months.
Right. So you got a cheap thrill out of it. If you bought it when it was low, a lot of people bought those stocks when they were 170, thinking they were going to go to 500.
Yep, exactly.
Right?
And that's the hard part. We're human, right? And we have that recency bias. We think in linear terms. If things are going well, we think they're going to go well forever. And when things are going poorly, we think they're going to go poorly forever. But it's interesting. I was just talking with a client about this the other day. It's like I was actually talking with Jake Cross, one of the planners on our team. It's like, I personally understand the behavioral psychology of what we're talking about, but it still doesn't stop those neurons from firing in my brain that say, well, maybe this is going to happen, or maybe that's going to happen, or maybe you should be thinking about this or thinking about that. And it's all, even though I know better, it's still hard, right? It's still, you think when things are going great, it's going to keep going that way and vice versa. Right.
It's a very good point. And that goes into like a real client story as it pertains to greed. And so,
yes,
like you mentioned, when things are going up, I think as humans, and it's not a bad thing. You just have to be aware of it. But humans think that, oh, the market's up, it's going to keep going up. I want to be super aggressive. And we're certainly okay with that. But you have to understand that if you're going to be super aggressive and you're going to be somewhat greedy, you have to understand that the way we invest money, when we hear that from a client, and we make this clear, is that if you don't need that money in at least 5 years, then it's completely okay to do that. But if you're putting money in the stock market and you're being aggressive and you're going to, let's say it's 100,000 and you're going to go put a down payment on a house or something, right? And you want to do that in the next 1, 2, 3, 5 years. You don't want to be putting that money all in stocks, right? Now, if you just need some dividends or interest off of it and you can afford the volatility, then we're all for that. But so you have to be careful of matching up your investments with your financial plan, right? And that is very critical. And that's where, like you mentioned, you have to be careful and not get caught up in all the hoopla and the mania and the craziness, whether it's good or bad, because ultimately for our clients, we want to marry their investments to what their goals and their purpose for their money and their objectives are. And that way you don't have to worry about the day-to-day swings and year-to-year swings. Frankly, they don't even matter really for our clients. And so even though we're tracking it very closely and we're managing it and we're watching it, ultimately, once we get a portfolio set up for our clients, we've got the 5-year plus money in stocks and the less than 5-year money in cash and bonds. And so we're managing that risk so that they don't get caught with their naked, as Warren Buffett would say, when the tide goes out, right? So that they're not overexposed. But that's good. So again, you want to be aware that if you are caught up in the greed or the fear emotion, which was again the second phase of today's show, that you need to take a step back and you need to understand that your emotions are good things and you want to experience and embrace them, but you don't want to act on them. And that's a whole different story. And again, as wealth advisors at Falcon Wealth Advisors, you and I have these conversations with clients, real client stories, saying, okay, Mr. and Mrs. Client, you want to be all stock. I just want to be very clear that this thing is going to make money and it's going to go down. But as long as you don't need the full principal anytime soon, and you're telling me you only need income or you don't need it at all, then that's okay. But if you know you're going to need the money, well, we need to look at doing something different, because I don't want to see your account down 30% and you say, Jake, I need it's time to go buy the house, because that's bad. We want to avoid that, obviously. And we can't. The good news is we can avoid it just by managing your emotions and managing, this fear and greed conundrum that we all experience as human beings.
And like we were talking about yesterday before we recorded this, or when we were kind of, preparing for this conversation this morning, managing risk and chasing returns are two very different things.
Good. Yes, absolutely. That's a really good point, Cory, because I think that's, again, the sexy part of what we do is that people love hearing, you made 20, 30, 40%. They love that. Right. And they love looking at their 401ks or their accounts or their IRAs and seeing their money double in a short time frame. Who doesn't you like that?
Of course. Who doesn't?
Right. But it's all fine and dandy until, again, I keep going back to this, till the tide goes out. Right. And risk is real, and people get burned and they lose money, and it takes years sometimes to get that capital back. And so you just need to be aware that you don't want to let your emotions drive your investment decisions, right? We're always going to give you our advice and we're going to explain those risks to you. But ultimately, you've got to be honest and truthful with yourself and clear with your expectations, and realize that, if you're coming to me and Cory and you're expecting us to make you 20 or 30% every year, we're not your guys. We're not going to do that, because to do that, you have to take an enormous amount of risk. And nobody can do that consistently over time. I don't care who they are. Nobody can do that. So you have to be careful with that and understand it.
To your point about the start of the show, though, and the kind of the three segments of what we wanted to talk about today, like you said, clients wanting to, if someone wants to make 20% or 30%, I do think a lot of that is a byproduct of overconfidence that investors are experiencing right now. After the last run that the market's had over the last 3 years, people think, well, I could go and make 20 or 30% seeing what the market's done, but to expect that to continue in perpetuity is not wise.
Right. And I wish it were, right? But it doesn't work that way. Right. I remember back in 2008, how bad the difference between 2008 versus 2020 is that 2008 was a 56% correction, which is crazy, right? Could you imagine half?
Sure.
I do, because I was there. you were finishing, were you in college in 2008?
Yep.
Ran around in college. So it's right before we met, I think, right?
Yep. We started working together in 2010.
Yeah. So, but I remember it. So it went down, but it went down every month a lot. So I think what's interesting is people opening up a lot of our clients, and this is most people, they kind of measure their performance by their monthly statement, right? So they get their statement, is it up or down for the month? And then they kind of forget about it, move on, because that's what they hired us. They hired us to worry about it, right? But every month, these accounts were going deeper and deeper and deeper and worse and worse and worse. And that's what was really hard. And the good news is, for the clients that I worked with and I'm still working with, we really remained disciplined. And if anything, we bought on that big dip, right? So when they did recover, they recovered faster. And more importantly, they didn't have money that they needed in the short term.
Yes.
And stocks is the most important thing. But after that, Cory, people's expectations for returns were far more muted than they are today. So people were like, "Oh, if you could just make me 4%, right,
Yeah.
or 6 or 7%, you're gonna make me 7%, awesome!" Like, because they had experienced all that pain for so long. I think it was 13 months or so is how long it lasted. But it's a year of basically going down pretty much every month is a painful thing to endure for a lot of people, especially retirees. And again, our clients that were retired then are still retired. And again, they had plenty of money in bonds and cash to weather that storm. That's why we use at least 5 years, ideally 10 years of money that you need not in the market.
Managing risk, right?
That's right.
Exactly what we just talked about.
That's right. So those are some real client stories. And, in your career, you've seen a couple of blips. And you know this as an advisor, people get nervous pretty quickly when we have those negative years.
Yep.
So it's always something that we're trying to balance for our clients. It's like, whoa, let's not get too greedy here, because, you can get burned. This is not a game. And then when they get scared, well, let's not cash in all our chips. Let's recognize that the market will grow or has grown over the long term. And so let's continue to buy into that and understand that. And so that's, again, a big part of what we do is investor psychology, investor behavior. All of those things are important. And so if you're watching this or listening to this and you have questions, or you feel like you may be overexposed, or you want to just talk about it, don't hesitate to send me an email. My email is jake@falconwealthadvisors.com. And Cory, yours is?
Cory@falconwealthadvisors.com. Cory. No,
right. Not the Kori with the heart above it. So
I did just get a Cori recently.
Cori. Wow.
Yep.
Yeah. So good. So as we go into our third phase here on what we actually do for our clients to manage, and what we're doing today, literally right now, to manage this risk. Quick plug, Cory. Why don't you plug your show? Because I know you've got your own podcast.
Yes, and Jake has joined me on the show quite a bit here recently, and it's been a good thing, and it's been fun to have these conversations. But the show that I host is called In the Money Insight, and if folks are subscribed to the Falcon Wealth Advisors Collective on YouTube, your show and mine are both there. And then, of course, the podcast, wherever people listen to podcasts, they can follow along too. So you're notified when new episodes become available.
Yeah, absolutely. Yeah, and same with mine. Podcast platforms. Thank you for listening. The best way to know that you're not going to miss another episode of either of our shows is to subscribe. Also, we do send out weekly email. If you want to subscribe to that, you can just send either of us an email. We can add you to that subscription list. You get that on usually Tuesdays around 10 o'clock is when those go out. I'm also on there on social media. So if you're on Instagram, Facebook, Twitter, or LinkedIn, feel free to send me a friend request. Cory, which ones are you on? I know you're only on a couple or three, maybe.
I'm on Twitter, LinkedIn, and Facebook. No Instagram.
No Instagram. We'll get you on there soon enough. And then our team, Falcon Wealth Advisors, is on basically the same 4 platforms that I'm on. Okay, so let's talk about things that we're doing today to manage risk for our clients. Now, we always do the 5-10 year thing, right? That's table stakes. That's standard. We're not going to invest clients' money unless we've got a good understanding of what that looks like. But what are we doing today to protect our clients from some of these risks that are inherent, or that are present, or that are growing, bigger or larger?
I would start with talking about portfolio positioning. So the way that we have money, for the money that's invested in stocks for our clients, by positioning that portfolio appropriately and diversifying, like you said, Jake, but also not following all of the trends necessarily that are relevant in the market by, overexposing our clients to the technology sector, or to cryptocurrency, or whatever it might be. We have made some changes to the companies that we're invested in, so we're not overexposed to any of those sectors.
Right, which is a huge value add in my opinion. So, so literally we've already rotated the portfolio. We know inflation is here. We know technology's had a good run. So we don't want to lose all the money we just made, and we don't want to be overexposed when interest rates go up and inflation gets hotter. And so if you're invested in an exchange traded fund, or even probably a mutual fund or an annuity, you're probably not going to get that necessarily. I mean, you could, but the problem is you don't really know. And in fact, if your advisor is using those products, they probably don't even know. And so I think as inflation presents itself further, as volatility continues to pick up, it is going to be even more paramount that you're working with not only a fiduciary advisor, someone that's only acting in your best interest, but also that has control over your investments. And they're not outsourcing it to a third party. Because the problem with outsourcing it is that if you go to a third party, Cory, they don't really know our clients, and they don't know our clients' goals and objectives, and they don't know our client wants to go buy a house or is pulling $10,000 a month to live off of in retirement. They don't know any of that stuff, and so they're not going to manage the money according to that. They're just going to go probably chase returns, frankly, or they might have some box that they have to live in, and they can't get out of technology because their mandate is that they are in tech. So you're gonna ride that tech wave up and down with them. And again, if your advisor is using products, you're also paying fees on fees, which drives us crazy, or drives me crazy. I know it drives you crazy. So it doesn't need to happen that way. So the good news is our clients know you and I and our team, we're managing the individual holdings. We're tilting it based on the macro environment, and we're going to monitor it very closely, like literally every day. We're going to watch it. So,
and to be clear, if the market declines 20 or 30%, I would expect a portfolio of stock mutual funds, a portfolio of stock ETFs or index funds, or a portfolio of individual stocks. The market pulls back 20 or 30%. I would fully expect any of those portfolios to be down in value if you have exposure to stocks, right? Just to be clear on that, but it's all about mitigating the downside, because the clients we work with, the reality is they've done the hard part. They saved their money. Most of them, if they're not already retired, they're close to retirement. They don't need to chase the returns. They don't need to make double digits in order to stay comfortable in retirement. We need to manage the risk, mitigate the downside the best we can, recognize the fact that volatility is part of investing, but it's not the enemy that everyone thinks that it is. Volatility also presents opportunity.
Right. Yeah, that's a really good point. And that's the risk premium that we were talking about. That,
yep.
I mean, if there's all these numbers out there that you could throw, but the argument is, would you be willing to take 100% return over 10 years if during that time you would also lose 10% any given window, right? So any rational investor would do that all day long. So you're saying, I'm going to double my money every 7 to 10 years, but along the way I might lose 10%, but it doesn't matter. So that's, like you said, you have to be able to stomach the risk. You have to be able to have enough dry powder on the sidelines so that you don't have to sell something when it's down, and be patient and be disciplined, right? And that's that's really why clients hire us too, is that we're not going to get panicked by the market when it corrects. And like you said, even our portfolio, we would expect it to be down if the market's down. But like you said, the good news is we're not overexposed and we're managing that risk. And so the idea is hopefully we're down less, so that when it does recover, we recover that much faster. And that's what really we're trying to do, because nobody can time the market. We're not going to guess and just say, well, we shouldn't be in, because it could go down. Like, that's very foolish, because again, you're going to miss that potential upside. And a quick history lesson on this is, if someone got out when the pandemic hit, they've missed out on enormous past couple of years. I mean, they have lost potentially thousands or millions of dollars by sitting on the sideline, by not staying invested. And so you can't do that. You don't want to guess and get out, because that's just playing with extreme fire. So we want to stay in, but we want to be in the right investments. We want to be managing that risk, diversify, doing what we're doing, with the idea that our dip is shallower and then we move up that much faster. All along the way, knowing money we need in the short term is not in the stock market.
Yep. And I also think we should talk about bonds and interest rates and inflation risk there and how we manage that, because that is also different than what someone might experience if they're in a bond fund, for example.
Yeah, that's a really good point. So bonds, the poor bond market it doesn't get much attention. I think a lot of people think it's boring, but we like boring and bonds. This is a good thing. You don't want excitement. So, but yeah, good point, Cory. So when interest rates go up, bond prices go down, right? Now, the beauty with our clients, they own individual bonds. And so even though your bond value is probably going to go down, we already know that's going to happen. When the bond matures, you get what's called the face amount paid back to you. So if you paid $25,000 for a bond, and because interest rates went up on your statement, it's showing that it's only worth 20 grand. Well, the good news is when it matures in 3 to 5 years, whenever that is, you'll get $25,000. So,
but it's paying you interest along the way.
Yeah, good point. And it's paying you interest, right? So Cory, why don't you talk about the difference, because you brought it up, in bond funds, which is a lot different than what we're doing.
So like you just described, Jake, if we own individual bonds, we know when they're going to mature. We know the face amount we're going to collect at maturity and the interest that those bonds are paying along the way. On the flip side, if I have money invested in a bond mutual fund, I don't own individual bonds. I own shares of a fund, and the money is pooled with all of, hundreds, thousands, hundreds of thousands. I guess it varies by fund, of other investors that are participants in the same fund. But the issue is if interest rates climb and the value of those underlying bonds in the fund decline, and someone else on the other side of the country needs to redeem their shares, they need to sell their shares because they need the cash, that requires the manager to sell something so they can raise the cash. And if they have to start selling bonds when they're down in value, even though you, the investor, didn't sell your shares, you could still expect the value of the fund to decline because the manager's having to lock in losses. And if you have a negative return on a bond fund, there's no telling when you will get your principal back. There's not a specific, expiration date or maturity date when those funds will come back to you. It's just a matter of what interest rates do from that point forward.
Yeah, really good point. So bond funds are very dangerous right now. I would be very careful what type of bond fund you own, because the good news is it doesn't mean you need to get out of them, but you need to understand which one you own and why you own it and what could happen. So that's something that we can review for you at Falcon Wealth Advisors. So again, we don't use them, but you might have one in your 401k, for example, because you can't buy bonds typically. You can't buy bonds typically in a 401k. So you have no other option. So we're not going to say go all stock, because again, you might be taking on too much risk, but there may be a different type of instrument within that 401k that we could look at and advise you on, so that you're not, again, up against this huge, huge headwind of higher interest rates. You're right, because those bond funds are going to get nasty. And so if the market gets volatile and then you got your money in a bond fund and it's going down, 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 you're going to be frustrated. So you got to be careful on how that 401k is set up right now. That's a good point. That's a good point. I'm glad you brought it up. That's why you're on the show.
Thank you.
That's why you're here. So good. So we talked a lot we talked about the different types of market risks: systemic, inflation, political, headline. All of that stuff plays into a factor. All of that we take into consideration when we're building a portfolio. We talked about fear and greed, where I think those emotions are wonderful, and I think everyone should experience them and embrace them. I just don't think you should act on them. And you have to be careful when you're getting out over your skis. You need to recognize that and say, whoa, am I just being greedy right now? Am I being unrealistic? You really need to be honest with yourself. And then the third thing, again, in my opinion, it pays to have a fiduciary advisor that's going to be managing this risk and not just subbing it out to some third party. Why are you paying this advisor if they're not the ones actually pulling the trigger and managing the money? I mean, that's, to me, I don't know why. The value of a financial advisor or wealth advisor gets cut in half, in my opinion, if they aren't managing the money directly and they're advising on it, right? So if they're advising you on your money and they're not managing it, I don't understand why you're paying them to do that. Now, if they're doing great financial planning work for you, awesome, but you shouldn't be paying them a percentage of your assets if they're not actually buying the stocks, selling the stocks, buying the bonds, selling the bonds, trading options, doing all these things that help generate your return. If they're not doing those things, I think you're getting gypped, in my opinion. So
that's good.
So good. So we talked
Summary.
about a lot. Is there anything else before we kind of wrap up and talk about our fun stuff?
I don't think so. I mean, I'm
All
sure
right,
there's a
good.
lot more, but we've covered a lot.
We did cover a lot. So as we wind it down here, Cory, is there any fun? Do you have any shows or TV or Chiefs predictions? You got anything you want to throw out on the show?
You know, I've been enjoying a podcast a lot lately. One that I listened to, I probably started listening to it back in 2020.
Oh, wow.
But I kind of got away from it, and now I've picked it back up again. But the podcast is called Stuff You Should Know. And what I love about it is that every episode is about something typically that's very obscure, something that you wouldn't think would be very interesting. But the hosts of the show do a really great job of taking a deep dive. Like, let me give you a quick example of episodes I listened to recently, Jake, because I think you'll get a kick out of this. One of them was about, which was actually super interesting, was about the Salem witch trials and the fact that hundreds of years later, we still don't really understand what exactly happened or why. But they've talked about the history of traffic lights, like literally traffic signals. I mean, you could pick just about anything, and they probably have an in-depth episode that explains all of the history behind it. And it's a lot of fun to listen to.
How long are the episodes typically?
So they're typically about 45 or 50 minutes, but the hosts also have a different, it's kind of the same show. It's maybe like a segment that they call short stuff. So they'll do other episodes on different topics that are only 15 minutes long.
Interesting. Do you listen to both?
You
do? Wow.
I usually will go through though and see what I'm interested in, which traffic signals don't sound very interesting maybe to people, but it was a 4-hour car ride. So I was tuned into some different episodes, but I learned a lot, and it was interesting to hear about something different.
Yeah. Good for you. I've heard of that, and I don't think I've listened to it. So thank you.
Yeah, in fact, Matt, who hosted the podcast series that you and I attended at the end of last year, I remember him commenting that is one of the shows that he likes to listen to because he admires the production quality of it.
Yeah, that's a good one. I listened to a lot of financial advisor ones, of course. But I found a new one. I think it's new that I think all of our audience would actually like. It's called Barron's Live. It's a really good one where like they did one on, they had a JP Morgan analyst on cryptocurrency, which I thought was actually, he did a really good job on that one. I just listened to one. What was the one I just listened to? Maybe it was last night I listened to one on the tech sector. So they talked about how technology's done really well, and actually kind of they were talking about how it's in correction territory and their thoughts. So I thought, so if you are interested in the markets, I think Barron's Live they're doing a really good job with I think it's a new show. So that's been a fun one. And the other ones are more for advisors that I don't think our audience would like. I'm reading a few books right now, still reading that Amazing Adventures of Cavalier and Clay. That sucker is long. I mean, it's really thick. Pretty good book though. I'm reading Conscious Leadership by the CEO of Whole Foods, which has been really, really fun to read. He's a really smart guy. And I'm reading a book called DeFi on cryptocurrency because I'm getting more questions from our clients about it. This book is intense. It's really short, but it goes really deep into all the nuances.
Who wrote that? Do you know?
No, it's at home.
Okay. I'll have to check it out.
It's pretty good. I mean, I think it was on like Bloomberg's best
book list. Okay.
Best book list or something is why I bought it.
I'm reading a book that you recommended. Think Again. Again by Adam Grant.
Do you like it?
Yeah, it's pretty interesting. It's like all the things that people think that they know for sure are the way that things have happened. And there's a lot of stuff that we're totally wrong about.
Right. Yeah. I like that one a lot. That's a newer book too. What about any shows? You got any movies or shows?
We're watching, Cassie and I just started Chernobyl.
Oh, is that good?
We've only watched one episode. Yeah, it's good, but yeah, it's pretty intense. It's pretty heavy. But we just started that.
Got it.
We don't watch. There's not a ton of shows that I watch really closely, but every now and then we'll just kind of get the itch to try something new.
Yeah. We watched Macbeth, which I think has Denzel Washington in it. Maybe plays Macbeth, which Rachel loved it. It's kind of hard for me to get into, but the cinematography was awesome. Believe it or not, it was in black and white, and the acting was top notch. So if someone's into Shakespeare, I think it was on Apple, maybe.
Okay.
Apple. I don't remember which platform, but Rachel really, I was like, it's okay. But it was If you like Shakespeare, it was awesome. Like you love it for someone that's a fan of Shakespeare. And I think it was Denzel Washington, and he's an awesome actor, obviously. So it's pretty good. All right, good. So I know that's all the time we have for you today. So thank you again for everyone that tuned in. Please, any feedback, send it our way. Like and share our content. Hope all of you out there have a great week.